So guys, again, we have three lenders: private lender, hard money lender, and conventional lender. And to me, this has been beneficial because depending on what type of deal I strike, if it's a rental property, if it's a fix and flip, if I have to close in a week or a month, it's good to have actually options, right? If you only rely on one lender, you might find yourself in a tough spot. So for me to have the option of calling Kevin and say, hey, can I borrow $100,000 on this property? And he knows real estate, he can go take a look and say, hey, it's a great deal, has been huge. It has been very beneficial to the company. And then hard money lender, obviously, Paul can act fast. There's a couple other hard money lenders in the room that have been excellent, but they can get the deal done in a week or two. And obviously these guys will talk about the plus and the minus of their service. And then Ryan comes in. If we got a little bit more time, if we have 45 days to close on a deal, I'd rather work with Ryan because there are some benefits there to the interest rates and things like that. Quick question, these guys reach out, what are you looking for? And what do they need to send you? Like, tell me a little bit about the process.
At Renovo, we're focused on quite a bit. We cast a pretty wide net, so kind of offer both short-term and long-term solutions, whether you're a rehabber looking to fix and flip a home and resell or refinance into our long-term 30-year rental program. Kind of have things covered, and we try to be a one-stop shop for the residential real estate investor. One thing that I think is probably differentiates us from a lot of nationwide lenders is the way that a lot of nationwide lenders are structured. They have a finite amount of money in-house, they fund loans in their line of credit, or they raise capital from other investors through crowdfunding type strategies, and then they resell that loan off to a third party, and a lot of times that third party says, hey, we'll buy your loan as long as it fits these guidelines, but you have to use my fund control company that I've vetted, my third party servicing company that I've vetted. So what that does to the customer experience is it really makes it very clunky and cumbersome, because withdrawals, you have to provide lien releases, invoices, material cost receipts, and it's literally now you have to hire a full-time CFO to manage your construction draw process. So it can be very cumbersome on that front. What I think, again, differentiates Renovo is that we service everything in-house, and our draw process is turned within 24, 48 hours, so it's a very relatively quick turnaround time, which allows you to then push your project forward, pay your contractors, ensure that they're continuously on the job site, and making sure that work's getting completed on time. So that's kind of what it is we do, and where I think we separate ourselves as a hard money lender. Rates are in line with where the industry is. 7.5 to 9, 1 and 2 points, and rates on the 30-year sides in the 4s. So if you're looking to flip a home or build a rental portfolio, love to talk to you. What we look for, number one, it is relationship driven. So I'm not saying that we're going to lend to anybody who has a pulse or anybody who has one deal under the belt or 2 or even 10 deals under your belt. If it's not a personality fit, it's just not a mutual fit at the end of the day, because business needs to be fun. It can't be stressful all the time. So if you have somebody pushing the envelope nonstop, then it might not be a fit on both sides. I think it all depends on the relationship first, second asset base. I want to make sure that we're lending in a good location, right? It has to be something that is easily tradable on the open market. And we also want to make sure that, just like Kevin said, if a worst case scenario happens where there's nothing that you can possibly do to really savor that deal, then you have to take the asset back. You want to make sure you're in a good place to dispose of that asset, should you have to get to that position. Now, from a documentation standpoint, I think it's pretty common in our industry where you have to get, we have an application, right? A lot of private guys, individuals might not have an application. They might not pull credit. They might not pull background. Those are things that we have to do because we're regulated. We're a large financial institution. So those are things that we have to do, but at the same time, it's not heavily scrutinized. So, we advertise that our minimum FICO score is 680, but in our reality, I've worked with guys that are 620 because they had a $45 missed payment on a Wayfair credit card, right? It just needs to make sense. It's common sense at the end of the day. So that's one thing, that I would mention, and then it's really experience-based. Like, whoever we work with want to ensure that they can actually execute on what they're planning on doing. So if it's a newer investor, maybe want to ensure that they have some sort of exposure in their history of being in construction, or maybe they're financially well off to where, from a collectability standpoint, if a worst case scenario happened, we'd be in an okay position, and the borrower's going to be able to make do on what they borrowed. And then obviously when you work with more experienced investors, the game changes. I mean, you have an experienced operator like Aniz and Joni. They know exactly what they're doing. They have great teams in place. You know, they're focused on specific markets. They know them very well, and that's very important in investing in general. So we look at a variety of different things when it comes to underwriting a deal, a borrower, and building a new relationship and trying to add mutual value to those clients. But I guess that's where I'd probably leave it.
We have sort of our niche in the marketplace. We specialize in construction lending. 60 to 70% of what I do is sort of multifamily renovation type lending, construction to permanent mortgages, where we have an interest only period of anything from 6 months to 12 months, and that converts to a 25-year note. I do an awful lot of that, but ground up construction as well. Spot lots, subdivisions, we do a ton of that stuff, and that's sort of where we're able to differentiate ourselves. I would say a lot of the documentation is probably the same. We do look at a personal financial statement. If for any new investors out there, just keep the cash position and that kind of stuff, whether it's a spreadsheet or otherwise, just kind of keep that up to date. And it's a good first impression when I ask, hey, you have a basic sort of personal balance sheet, and then send it right over, along with the tax returns, and all right, now we're off and running. We do run a credit check, but unlike some of the Fannie Mae products that we look, that some of you might use for like a personal mortgage, we can kind of be a little bit more flexible with things like credit score. Similar to what Paul said, if it's reasonable, we keep all of our loans in house. It's a portfolio lending situation, so if it's a reasonable loan, we're going to do it. If it's a Home Depot credit card and it's $100, you missed one payment, that's what's affecting the score. We'll look the other way on stuff like that. So we can be flexible when it comes to sort of like debt to income ratio type stuff. It's much more about the property that we're looking at. So to go back to your question, it's like when we're looking at some of the primary stuff that we look at, if it's a 4-family property, we look at it as, all right, what's our number one repayment source? It's the building. So when that appraisal comes back, what do those rents look like? What's our loan to value? We really hang our hat on that. Secondarily, if the property experiences some vacancy, well, all right, well, what does our guarantor look like? Do they have cash? That's the number one thing. If they don't have that, all right, what's their income look like? And then it's sort of debt to income, so it's a lot more lenient, I would say, than the typical Fannie Mae product. I guess the only other thing I would add is sort of like the environmental aspect. We obviously have to sort of check that box too, but if it's a residential type of loan product, there's not as many guidelines when it comes to that. It's more like a shopping mall type stuff. We got to make sure that we're in good shape there, but that might be the only I would say differentiator between us. But they tell me the same thing that they probably tell Paul, which is act like it's your own money. Go and meet with the person, look them in the eye, shake them in the hand. Would you lend to them? And so character's big for me. Can I do business with you? Is it going to be fun? I like that too. So yeah, hopefully that provides some benefit.
No, that's great. One thing you guys probably notice is the common thing of building relationships, and I want you to understand that part. These guys are human. They can become your friends. They're just not the lenders or a bank. Super important. The other thing, last thing I want to mention is the fact that they become your partners in the deal to some capacity, because they are lending you money. They become your partners. So if they approve a deal, it means it's a good deal. So they are your sounding board. They are a second set of eyes on the deal. So look at it that way. It's a partnership at the end of the day. So, guys, thank you. Thank you for being on stage. I know you don't do this every day, so I appreciate it. So, guys, thank you.